Hey everyone, Richard here, and in this video today I want to share with you and help you to answer the question for yourself: is buy-to-let property still profitable at 5, 6 and even 7% interest rates? Over the last few weeks we've seen the base rate in the UK go from 0.25% all the way to 3%. Now, this is having an adverse effect on buy-to-let property investors if you're solely investing in buy-to-let property, which is basically the strategy as a single let. So if you're investing in 1, 2-bed apartments, anything like 2-bed terrace, 3-bed terrace, any sort of family homes where you've got one tenant, a family, a single person, a professional couple. If you're just doing the traditional buy-to-let property investment model, then your margins are going to be reduced because of the interest rate rises. Now, with that being said, I know myself, being a successful property investor and a property entrepreneur, that the key to remaining successful in the market and scaling your property portfolio is to make sure that you're adaptable and not rigid. So in today's video, I want to share with you a spreadsheet that I use from my flagship training program, Property Investors Accelerator. Now, I'm going to share with you a model which is going to help you to understand how to be adaptable, what I'm using, what my clients are using, in order to make sure that we're still profitable and we still have good margins in our investments, and that our investments still make sense even based on the 5, 6 and 7% interest rates that we're currently seeing if you're investing in a buy-to-let property under a limited company structure. Okay, so before I jump into the spreadsheets and go through that with you and basically introduce you to what I'm doing and a strategy called title splits, if you don't know who I am, I'll explain who I am now. So if you're new to the channel, my name is Richard Norris. I've successfully built a multi-million pound property portfolio, and my group of property companies does over 200k per month. Now, also, like, if you are new to the channel, please make sure you subscribe if you haven't already. Please make sure you hit that like button. It will really help bring more traffic my way and basically get my content out to more people, and I'd really appreciate it for that reason. And lastly, please make sure that you ring the bell so that you can be notified of any new content. I release content twice per week, so if you want to be notified when I release any new content, make sure that you hit that bell icon. So with that said, and without further ado, let's jump into the spreadsheets, and I'm going to show you how to make your buy-to-let investments profitable at 5, 6 and even 7% interest rates based on the current economic position that we're in right now, based on a recession, and based on being adaptable and implementing this strategy for yourselves. I'll see you in the spreadsheet. Okay, so let's jump into the spreadsheet. So like I said, and like I alluded to earlier in the introduction to this video today, like, this is one of the spreadsheets that we use in my flagship training program, Property Investors Accelerator. It's what myself and my clients use when we're looking at, like, specifically like taking a 2-bed property, like a 2 up, 2 down property, and splitting it into like 2 flats. It's a strategy that I love, and right now I believe it's a great strategy to offset the current market interest rates of 5, 6 and 7%. And it's always prudent when you're doing your financial modeling to work at the 7%, 8% and stress test those values, because we want to be prudent. We want to build contingency in, because for me, whenever you're doing any property investment, it's all about managing the financial downside so that we can be guaranteed of the upside. If you manage the financial downside and everything works at like the worst case scenario, then you're building a recession proof property portfolio, which is what we want to do, right? Especially when we're in a recession in the UK right now, this becomes even more apparent, even more fundamental. So let's just jump in. So, like, this is the spreadsheet. I'm going to take you through it. I'm going to show you how you can still be very profitable using this strategy, as opposed to just doing a single 2-bed sort of terrace property as a buy-to-let, or a 3-bed terrace property as a buy-to-let as well, using the typical the buy, refurbish, refinance process, right? So I was just doing some searching on the internet a minute ago, looking for like a property for myself, like thinking about like what other properties I could find for my own portfolio, and I came across this property, so I want to share it with you and how I'd analyze it. So this is a property in Stoke-on-Trent. It's in ST6 Stanley Street, and this is the property that I looked at. So I went on to Rightmove and I found this property. I just typed in 2-bed properties, minimum value at 60k, maximum value at 90k, and I got these properties that came up. So this is like a perfect kind of thing which you could take and do a 2-bed property, which is basically 2 up, 2 down, 2 bedrooms upstairs, 2 reception rooms downstairs. So if we take a look at the floor plan, 2 bedrooms upstairs, 2 reception rooms downstairs. That's what I call a 2 up, 2 down property. And what I'm saying is that we can split this property into 2 like 1-bedroom flats, right? 1-bedroom apartments, and we can make them quite spacious. And the reason being is, you can see like here, you've got 40 square meters on the ground floor, 40 square meters on the first floor. Now, whenever you're doing a flat split, like you will see some people do like flat splits below 25 meters squared. And I've got apartment blocks that have like units of 11 in and 11 apartments. And some of the units in there are below 25 meters squared. Now, if you're it's really important to understand this, because if you just want to get individual mortgages on each flat, your flat size needs to be above 25 to 30 meters squared, right? So typically speaking, 25 is the lowest value, but the optimal size of the apartment should be 30 square meters or more, right? So the fact that we're at 40 square meters here is really good. And the reason that I have some that are below like 25 meters squared is because if I'm taking out a commercial loan on, say, the whole block of 11 apartments under one freehold, then it doesn't matter. It's irrelevant, right? If you wanted to sell the units, then ultimately, and you didn't sell it as a block, and you wanted to sell them as individual apartments with a single lease of like, say, 125 to 250 years, then if you wanted to sell those apartments and they were under 25 meters squared, you'd be only attracting cash buyers because people wouldn't be able to get a mortgage. So you'd be limiting your pool of buyers in the market, right? Which could be adverse to you. So it's just something to consider. So both of these apartments are 40 square meters, which is great. They're nice and sizable and a great size for one bedroom flats, right? So we could create a one bedroom flat on the ground floor, one bedroom flat on the first floor, okay? And as you can see, it's currently on the market for £85,000. So I'd go over to my sheet and I'd put the guide price as £85,000. And then I'd say, okay, what do I think I can purchase it at? Well, the property needs a bit of TLC. If we go into it, you can see in the pictures here, if we go to the gallery, so if I go back here and I go into the pictures, right, you can see here like it's not in great condition, right? It needs some love and attention, okay? So like I would say, like, let's start like running the numbers at putting an offer in at like 75. Ultimately, to be honest, if I was doing this, I'd put an offer in to start with that was lower than 75. And the reason that I'd go lower than 75 is I'm constantly telling my clients that you don't ever want to get your offer accepted immediately. The reason being is because it's our job as a property investor to get the best possible purchase price, because sometimes we can make the money on the day that we buy, not when we sell, and we can buy below market value, especially if we're doing a buy, refurbish, refinance model. You don't have to buy below market value. You can still buy like close to full asking price sometimes, and the deals will still work. But the great thing about this spreadsheet is we can change these variables and these inputs to see what that does to our ROI later on once we build it out. And I'll kind of do that at the end for you, just so you can see how that works. But for the purpose of this example, let's say that we go in at 75. And the reason that we go in at 75, like I said, and like I was alluding to, was that we never want to get our offer accepted on day one straight away, because then we don't know what we could have negotiated. Like we probably paid overpriced for it, because if we're paying 75 and it gets accepted, maybe we could have put an offer in at 67, 70, like we don't know where the bottom is, right? So that's like the rule that I have, is I never want to get my offer accepted on the first kind of offer, okay? So now for the purpose of this, I built this out as cash in, mortgage out. So we're going to buy the property for cash and then we're going to refinance on a mortgage. You could do mortgage in, mortgage out, or you could do bridging in, mortgage out, but I don't want to confuse you. So I'm just doing cash in, mortgage out. And the reason why I like to do this strategy is cash in, mortgage out as a model is because you can use mortgages, but it's like there's more nuances to it, more complications, because ultimately, like if you're going to do like mortgage in, mortgage out, typically speaking, most lenders won't like you to basically change a 2-bed property that you've got as a 2-bed terrace under a mortgage and then split it into 2 flats. You'd need to notify them, and you're going to have an early repayment charge. So when you're doing flat splits, it's better to go like bridging or cash in, mortgage out, right? So I'm going to show you cash in, mortgage out for the purpose of this example. So cash, there's obviously no deposit that goes in here. Cash purchase is 75,000. That automatically gets entered once we enter the purchase price. Then we have solicitors fees. Now I've allowed £1,500. You could be lower or more depending on where you are in the country, but for ST6, you know, for this value of property, it's going to be around the 1,500 mark. And this is an important thing as well to note about how I model things out. Whenever I'm modeling in my spreadsheets and doing my analytics and my financial sensitivity analysis, I'm always working to worst case variables. So I'm always working to that upper limit with the aim that when I get the property, when I'm on site and I'm trying to reduce things, I'm trying to reduce my cost, I'm trying to reverse engineer those calculations and those costs so that I can get better value and make better ROI and more profitable deals, right? So 1,500 is what I put in. Now, valuations and specialist reports, there's obviously going to be no broker fee because we're going cash in. And so we have a valuation to pay for and maybe some specialist reports. Now, in this example, I'm just saying, hey, we have one valuation, right? Now we've bought by a home valuation report, and you can get those for around 450 plus VAT. I've allowed 750. Again, I've allowed for a little bit of contingency there. If you had any specialist reports, let's say you had damp proof, or you had asbestos, or you had a structural survey that needed to be done. You just add that cost in here and you change whatever you think that number is. So if I had a structural survey on top for like £500, I would put this number as £12.50. And yeah, you just make it relative to the specialist reports that you need. Then you have stamp duty. Now there is no stamp duty to pay it on the first 2% because between 0 and 250, based on recent stamp duty changes, we don't have to pay the first 2%. So 2% at 75,000 is obviously void. And then we have the stamp duty at 3%, which is 3% of the 75,000, which the spreadsheet automatically works out for you based on the formulas and inputs put in, is 2,250. Then we have something called project hold cost. So if we go into this tab here where it says hold and rent, we can work out, okay, in this section here, like what are our costs, right? What of our monthly expenditure whilst the refurbish is going on? While we're changing this and converting this property from a 2-bed terrace, a 2 up, 2 down into 2 flats, like we have costs going out of our bank every single month during the refurbishment process. Now, because we're basically buying this for cash, there is no mortgage. That's why it's at 0%. If you were taking out a mortgage, you put the mortgage value here that you're taking out on day one whilst you're doing the refurb, and you'd put the mortgage interest rate divided by 12 to give you a monthly interest rates in here. Okay, but because it's cash, there is no mortgage here. Then we allow for standing charges. Okay, I'm just going to put myself over here so you can see this. Then we allow for standing charges. So gas, water, electric, and council tax. Now, I typically allow £20 for each utility. For gas, water, and electric, £20 each. That's the standing charges whilst it's vacant. And then you allow for your council tax. Now, on a property like this, just like to be completely transparent with you, where it's like, to be honest, it looks like it's inhabitable. Depending on how the working facilities are, we may even be able to get empty homes relief from the council, and therefore there will be no council tax, and we could apply for that. The moment that we strip out the services, so we'll strip out the kitchen and we turn off the running water supply, we can apply for no council tax and get council tax relief. But I'm going to allow it with council tax in. I'm going to assume that in ST6 we have to pay £150 a month in council tax. Therefore, the hold cost per month on this specific deal whilst we're doing the refurbishment cost is £210 a month. Now, if we take the £210 a month and times that by 6 months, I'm saying, hey, 6 months to do the refurb, to split it into 2 flats, and then to get tenants in is going to be £210 a month times 6 gives us our £1,260 here. And again, if you wanted to change this and reduce the number of months, you could put 4 here and it works out to £840, right? But for this deal, I'm going to say, hey, let's allow 6 months. And again, I'm always allowing for contingency of time. I think we could probably do it in 4 months, but I'll go with 6 months to be kind of conservative and allow for that contingency. Then we have a sourcing fee. So if you found a sourcing agent, if a sourcing agent found this property for you, put the sourcing fee in. But on this specific deal, we're saying we found it directly from Rightmove, right? Now, then we have the refurbishment and build cost. Now, specifically speaking, in this area of the country, like with my build team, I could probably do this for anywhere between roughly around 40 to 50k, I reckon. So I'm going to put 40k in here for now, okay? And then we can reverse engineer this, right? We can reverse engineer that number up and down at the end once we build it out, so you can see what effect it has on the ROI. But let's just say it was 40k to refurb this property into a 2-bed, into 2 flats, okay? Then you have the utilities, right? Now, over here, this is really important. So I've listed out here, this is what's great about the spreadsheet. I've listed out every single line item that you're probably going to have if you're doing a 2-bed terrace conversion into 2 flats. So you're going to have your architect's fees, okay? So you're going to have your architect who maybe knock up some architect drawings for you, some CAD drawings and stuff, and make them into construction and working drawings. And initially you're going to have your planning costs, and within the planning costs, which is like 1,500 to 3,000 is what I would allow for something like this. That allows for basic planning drawings from your architect, and it allows your planning fees to the council and to submit the application. Anywhere between 1,500 to 3,000 is your planning costs. And then you have like your architect's fees. Okay, now I put the architect's fees on top, so I'm allowing another 2,000 to basically take the drawings at planning and convert them into construction and working drawings. I allow roughly 2k on a project like this. And then again, like this 1,500 to 3,000 includes some architect's fees within that number as well. Okay, so you'd put like what the actual fee is. So in the architect here, we might allow £2,000. And then in the planning costs, we may allow £3,000, right? So you put that in there. Now straight away, you can start to see that it's already started to top up our total professional fees, and I'm going to explain this in a second. But when we input stuff in here, for what we allow for each of these line items, it starts to calculate our professional fees down here, okay? Now, utilities, this is like your separate line item. So the next thing is like utilities. And honestly, this can really vary on the project. It can be as minimal, like there are no utility connections, which is very unlikely. You're going to have to do some work to utilities, but I've put 0 to 20,000 here. Now on a 2-bed, 2 up, 2 down, 2 to 2 flat conversion, which I'm showing you in this example, I roughly allow £2,000 to £3,000 per unit. That's what it roughly works out to be based on my experience with my own build team. So I'm going to allow the worst case. I'm going to say £3,000 per unit. I'm going to go for the higher figure times 2. So I'll put 6,000 in here for utilities. Okay. And you can see here, that's the utilities that goes in there, 6,000. And then we have our building warranty. Now the building warranty, we need to get a building warranty when we're doing this because we need 10 years guarantee of like NHBC warranty, right? Now, unless you're using a contractor that has an NHBC new build warranty, it's highly unlikely that you would use that because they're usually the bigger construction firms. The smaller construction firms, like your local builder that might be doing this 2-bed conversion, is unlikely to have an NHBC new build warranty, right? So I always allow the building warranty. Now, recently, like I've done an 11 apartment conversion, and the build warranty on that was around £12,000. So it worked out to be like, you know, typically speaking, like just over £1,000 per flat. So I'm going to allow, like, in this number, I'm going to allow 5,000, and you're going to see like I'm being really over the top here. You could probably get it done between 2,500 or 3,000, but I'm going to allow 5,000 as like the worst case. Okay, again, always using the upper limit. So I put 5,000 in there, and again, you can see it's starting to increase my total professional fees. Okay, then what we have is we have our SAP. Now we have our SAP calculations that we need to do. You must get those in order to be able to rent them out at the end when we come to refinance. It's important. So our SAP calculations are about 150 per flat. So there's 2 flats, 150 times 2 is 300 goes in there. And I've also like put some links in here as well. So if you like click on the link, for example, like it will take you to like a page where you can see like SAP's UK, Energy Consultants Limited, like you can see them listing out what they allow as well. So you can see like I'm using realistic figures here. I'm not making anything up. It's not fictitious numbers. It's not arbitrary. This is exact science. It's exact data. This is what I do, and this is what I use when I'm doing my calculations. Okay. So there you've got that. Then what you have is you have to allow your EPC. Now this does depend on where you are doing this in the country. So you'd just go to the local council site and you'd work out what your EPC is. I've got one here for like checkertrader.com on what the EPC is. Sorry. The EPC, I'll rephrase that. I jumped onto building control. Your building control depends on the council. Your energy performance certificate is a national cost. Okay, and I've got like another link here for you, checkertrader.com, where it'll tell you what the price is. And it's like anywhere between 35 to 120 pounds that you should allow per unit. So again, we've got 2 units, 2 flats, 120 times 2 is 240. So 240 goes in there. And then what we have is we have our building control. Now this depends on council to council. So across the UK, your building control can be as minimal as £500 to £2,000 per unit. And again, I've just used an example here from Northampton. It was one I found on Google. So you can basically see like what their costs are. So if you click on this link here, you can see what the costs are for Northampton. So you can see again that we're using real life data, and you can see that you have like 2 dwellings, full plan applications, £187. Then you have your full plans inspection at £559. And then you have your building notice at £819. So in that example there, you're probably looking at like 600 plus 200, like 800 plus 800, about £1,600, right? Just under £1,600, give or take. But in this example, because it's Stoke-on-Trent, like it's £500 to £2,000 per unit. If I allow £1,000 per unit and kind of go in the middle, times 2 is 2,000 that goes in there. Okay. And then what you have is you have your individual lease and title split. So if you were basically splitting the titles and say, for example, you're doing like, let's say that this was number 35. The address was 35 Stanley Street. You might have 35A Stanley Street and 35B Stanley Street if you did a title split, and then you could split the leases into 2 separate units, 2 separate leases, 2 separate titles. If you wanted to, you could rent them out individually, and if you wanted to, your exit plan could be sell one, keep one, or sell both of them individually. In my opinion, like in this example, I'm going to say I'm converting this to two apartments. I'm going to refinance it under 1 freehold. But I am going to do a title split and have 2 separate titles because I want 2 different addresses so that the bills are separated. But but I'm not going to put two different leases on them because I'm just going to do it under one freehold. So in order to do the title split, you're looking at around £540 to £1,020 per unit. That does include the individual lease as well. And then you have a standard template lease of £1,200 as a one-off fee if you were to split them into leases. But like I said, I'm not going to split them into leases. This is a freehold property and I'm going to just split the title. So I'm going to allow roughly £540 per unit. That includes that. So here would be £1,080 to do the title split, okay, with my solicitors. Now, if you can see over here already, it tells me what my title split and leases are, which takes this cost here, which I've put in here. And then what you have is you have your total professional fees. Now, your total professional fees are made up of this: your 2,000 architects, your 2,000 planning costs, your building warranty at 5,000, your SAP at 300, your EPC at 240, and your building control at 2,000, right? Okay, so that's what that allows for. So you have your costs there, right? And then you have like angel amounts if you were to use private investment. But again, for the purpose of this example, to keep it really simple, just so you understand, it's basically just cash in, mortgage out, and we're going to leave out creative finance for this moment, saying that you were the investor, you brought this cash, and then you're going to refinance onto a mortgage. So to do the total deal, it would cost you £140,380. That's a combination of what you purchased the property for at £75,000, your solicitor's fees at £1,500, your stamp, your valuation at £750, your stamp duty at £2,250, your project hold cost at £1,260, your £40,000 refurb, your £6,000 utilities, your £1,080 for your title split, and your £12,554 of professional fees, right? So that basically includes everything, which is £140,000 cash to do the deal. If you were to do this on a mortgage, just as an example, it would be basically be you take your £75,000, you times it by 25% to get your deposit, so that calculation there, and then you'd add in all of these associated fees, which is your solicitor's fees, your valuation, your stamp duty, your project hold costs, your refurbishment costs, your utilities, your title split, and your total professional fees. Would mean that it's £84,000 because you've only got the 25% deposit to put in of 75 and not the full 75 on day one. Okay, so but for the example, like I say, cash in, mortgage out, £140,000 of cash to do the deal. Then you have the new done up value. Now, the way that you'd work that out, if you go over to like property for sale in Rightmove, and like I say, I was working on this earlier, something that I was looking at and doing a project in Stoke-on-Trent. So I was doing my research, and if you look at like this, like the average house prices that things are selling for in the area, just to be able to gauge it. And again, you can look at the sold house prices, and you would do that as an exercise. But for the purpose of this video, I'm just going to go to make things really simple. I'm just going to say, hey, what is roughly the average house price that things are selling for on the market for a one-bedroom property, which is a one-bedroom apartment in Stoke-on-Trent? And you can see we've got one at 95,000. And if we click on the one at 95,000, let's see this. We can see that the flat here is a one-bed flat, and it's, you know, it's quite sizable. It's probably a little bit bigger than what our flat is, so we're probably not going to get as much as that, like 95,000 there. So if we go back and have a look for each of our one beds, you've got one here which is on 85,000, and it looks like this is a studio apartment as well. So if we look at the floor plan here, yeah, sure. So we can see that this is a studio and it's approximately 22 meters squared, which is pretty much half the size of our one beds. Remember, our one beds on the floor plan over here, if we go back to here, our floor plan, our one beds were sized at 40 square meters each, 40 each, right? So this is like half the size and it's selling for 85,000. So that's a good indication that the minimum value that we could probably get is around 85. This is an ST4, we're in ST6, slightly different postcode, but give or take, we're kind of starting to get an idea of what we could sell our property for, right? And then if we kind of have a look, you've got some at 80 as well. And if you take a look at this one at 80,000, we can kind of see what this looks like. And again, you've got, this is like already done. This is like the exact type of thing that we're speaking about. It's like a property and we're splitting it into a ground floor and first floor. By the looks of it, the split's already been done. And if we look at the floor plan, yeah, you're at 31 meters squared, right? So again, it's still smaller than ours and it's selling at 85,000 on the market for, let's say it gets offer accepted at 80, which means that it's like, you know, we could basically say our one bed is probably going to be more than 80. I think we could get more than 80 based on that ours are 40 square meters, not 31, but I'll go worst case and say that we get 80 for each. So we'll go 160 as the done up value here. So put 160 in there. And then we're going to take out a new mortgage. So 75% of the 160 is 120. And then we have our equity, which is the difference between the 160, what the house is worth now, the 2 flats are worth now. What the lending is the mortgage on the property at 75% loan to value is 120. The difference between these two numbers is 40k, that's the equity. And the money we take out is 120 because we bought it cash. So then when we take out the mortgage goes back into our bank account as cash. So we pull 120 out and we only leave 20 in, which is the difference between the 140 that we spent to do the deal and the 120 that we get back. So we take 120 out and we only leave 20k in the deal. Now, what we do then is we go over to here and we start putting the flat, what we think we can rent these flats for, right? Now, if I go into properties to rent, so if you go into like Stoke-on-Trent and you start to look for properties to rent, you can see like in ST, you've got like properties to rent in and around Stoke-on-Trent. And you can see like here in ST4, you've got one at 650. So if we like take a look at this one, it's a 1-bedroom apartment. Let's have a look at this. Does it give me, there's no floor plan, so we can't see how big it is, but let's just take a look at what does it look like. Okay, so it's pretty nice. It's pretty nice, but the kitchen and stuff's pretty small, so it doesn't look from me, yeah. I mean, this gauges it. It's like, again, you've got your open plan kitchen and dining area. You've got a separate bathroom. And that looks like maybe that's the bedroom potentially. So yeah, it looks quite small, but we don't have a floor plan, but that's renting it out for 650 on the market, and you've got let agreed there as well. So let's take a look at these ones like 525, ST1, ST2, ST4. So, I mean, if we look at here, we've got like 525, 550. If we take a look at this one, it's got let agreed on it as well. 1-bed apartment, no floor plan again, but it's renting out for £550. Okay, see if we can find one with a floor plan. We don't necessarily need to find one with a floor plan, but you know, it'll give us like a good gauge. This one's in ST3 and it looks like it's rented out for 475. It's just jumped there. Where did that go? But yeah, you basically get the idea, right? You just go through Rightmove and you start looking at like what roughly things are renting for in like ST in Stoke-on-Trent. I mean, you could even put in here like ST6 and see what if that gives you any more of a better indication, and it comes up with that. But yeah, so anything between like 500 and 650, or 495, 475 and 650. So if you take like the average, sorry, it's just rendering a bit slow here, video whilst I'm recording. But yeah, if you take the average between say 495 and 650, I think if you said safely, like conservatively, you could put in like 525 or 550. So if we put the upper end of 550 to start with, so 550 for each flat, so flat 1, flat 2 rents out for 550. Straight away it starts to work out what the rental income is, which is 1100. It pulls in what the mortgage is on 120 at 5%, which is £500, which is the 120 times 5% divided by 12. The formula is done for you here. Okay, so it works out automatically for you. Your management fee is 10% against the gross rental income, which is £110. And then we allow 10% of the gross rental income of £1,100 for monthly operating expenses. Things like buildings and contents insurance, a little bit of wear and tear and maintenance throughout the year. And it allows for a little bit of like annual pat testing, boiler service, all those sort of things. So your gross profit is £380 in this example, and it's giving you 22% return. Like a 22% return, £380 profit at 5% interest rates. And at 6%, you can see that you're still getting like 16.5% return and a £280 gross profit, right? So, I mean, like, these are pretty good. I know like the target here says like 25% plus, but like, honestly, that's a subjective thing. Like the 25 is there for like, if you're a new investor, like ideally, if you can get like 25, it's a really good indicator, because what that means is basically that within 4 years, this property doesn't owe you anything. So in 4 years, the 140 that you invested, you've already got that 140 back in either cash out plus cash flow, and you're ready to go again. But with that being said, like 22 is still a very good return because it's only looking at cash on cash here, right? So like this works pretty nicely, right? So, I mean, the next thing that you can do is you can start looking at like, what is the gross yield? Straight away, this calculates as well for us. Like it says, the house price is 160,000. It tells us what our gross rental income is a year, which is 1100 times 12 is 13,200. So it tells us the yield on this property is 8.25%. And that's the key. The reason that we force the yield, I reckon roughly the yield in ST6 is around 6% for a normal buy to let. And because we've been able to split it into 2 flats, we've been able to increase that yield from 6% to 8.25%. We've been able to get profitability and still keep a good margin at the 5% interest rate or the 6%, right? So that's good. And that's basically one of the key things you need to do in the market right now is increase your yield so that you can offset that rise in interest rate. Now you can see the total return though is 45%. So it really does smash our 25% because we're actually getting 45%. Now, what is the total return? So if you go overleaf here, basically that's this part here in the total return formula. So what this says is well, the house price is 160, £80,000 is the done up for a 1-bedroom flat in ST in Stoke-on-Trent. And we said that if we assume that we get 3% capital growth that year, now the average capital growth across the UK right now based on data is 7.5%. So if I'm allowing 3%, I'm being very conservative still. But if I'm saying 160,000 is what they're worth now, if the flats go up 3% in the next year, they basically rise by £4,800 in capital growth. Now my net cash flow is effectively £4,560. This effectively is basically pulled in from here. It's basically your £380 times by 12. That gives you annual net cash flow, which is £4,560. It pulls that in and it tells me my total capital return therefore is £4,800 in capital growth plus my cash flow, which is £4,560. So my total return for that year based on 3% capital growth and pulling in net cash flow of £4,560 is £9,360 per year. That gives me a 45% return, right? So it takes the 9,360 divided by the money left in the deal, which was the 20,380. If you remember from the previous over here, which we worked out, money out, money left in, money out, see? So we take the 9,360 divided by the money left in the deal times 100 to give us our percentage. The total return on this deal is 45%, right? Now, if we assume no capital growth, and we go like worst case, we're making 22% at 5% interest rates and 16.5% still with a margin of just under £300 at 6%. So this is a very profitable deal and it's stress tests as well. So if we go over to here as well, what we can do is say, well, okay, well, what happens if interest rates went to 7%? Well, even at 7%, you can see that it pulls our mortgage goes up to £700 a month based on the 120 lending, and our gross profit is £180 and our ROI is 11%. So you still make 11% on your money as a worst case, not including capital growth, just 11% on a 7% stress test. So you can see, like, you know, if you answer the question, is buy-to-let still profitable at the 5, 6, 7% interest rates? The answer is yes, it is. If you're using the right strategy, you know what you're doing, you're able to force that yield above 6%, you're still going to be profitable on simple buy-to-let models. Like, ultimately, if you go bigger commercial to residentials like I do, I take office buildings, convert them to multiple apartments, like 11 plus apartments. On those deals, you're going to hit your 30%. You're going to hit your margins as well. That are going to be much higher. You're probably going to be looking at anywhere between £1,500 to £2,500 a month of net cash flow from one property. And for most people, that could be their financial freedom figure if it's hitting that £2,500 a month. Okay. So, and HMOs, serviced accommodation, things like this, where you can really extrapolate that yield, they're going to be profitable at the higher interest rates. And like I'm showing you, like in the worst case scenario, if you're just getting started right now, 2-bed terrace properties, 1-bed flats, 2-bed flats will work, but you'll have to reduce your loan to value. You'll have to take your loan to value lower than 75%, to be honest, if you want to get like good profits. So in order to still leverage up at the 75% level, I'm saying to my clients, and I'm doing it myself, I'm saying, hey, let's just increase the yield of the asset. One simple way to do that, which is not too complex, is just to take a 2 up, 2 down property and split it into ground floor, first floor flat. And you can see that you can get these numbers. So I hope you found this useful. I hope you learned something, and I hope you found the spreadsheet useful. This is just, like I say, a high level example of what's included in our program, Property Investors Accelerator. We actually have, this is like the most simple spreadsheet that we have. Within the program, we have like tons and tons of spreadsheets, tons of financial modeling systems that analyze cash in, mortgage out, mortgage in, mortgage out, bridging finance in, mortgage out. It compares everything. We have deep financial models within the program. So if you're somebody who's analytical, somebody who's getting started, somebody who needs help with the numbers, or if you're an existing property investor that wants to scale up and you want really detailed metrics, systems and data to scale, our program has all of that. And we have some spots available within our program right now. So if you want to apply or you want to see if we're a fit to work together, just click the link below in the description There's a link where you can schedule a call to basically find out more about the program, to see if it's a fit for you, to see what working together looks like, and for us to see if you're a fit too. So if you want to basically take your property portfolio to the next level, or you're somebody starting out and you have cash or equity to get started, then, we'd love to work with you if you feel that we're the right fit for you. Okay. And vice versa. That works both ways as well. We don't just let anybody into our program, just being really prudent about that, because we really want to maintain a high level of caliber. And we only work with 360 clients on our front end offer, and on our back end offer, we work with 100 clients. We only work with, in total, 460 clients in any given 12-month period. Like I said, right now we have some spots available. So if you'd like to apply, you can just click below the link, click the link below in the description, click the link, see if we're a fit, jump on the call. We'll qualify you. We'll find out about your situation. We'll be honest with you if we don't feel we can help you, but if we feel we can help you and you're a great fit, we'll show you what we have to offer, and we'll see whether it makes sense to work together, and if that opportunity makes sense for both of us. So like I said, I hope you found this useful, and equally, if you don't want to apply, that's also fine. I create free content on the YouTube channel, and you can see I go into a lot of detail because I generally want to give value. I generally want to help you. But if you are somebody who just wants to expedite the process, take the theory and put it into reality, and implement the how of actually how to apply this, not just the learning of how spreadsheets work, but actually how do I apply this into the market, and you want that application and the hand holding through that process and the support, and to jump in with a like-minded community, then we'd love to hear from you as well. Cool. So like I say, hope you find it useful. If you haven't already, make sure you subscribe, make sure you click the like button, make sure you ring that notifications bell, and I'll see you in the next one.